Most people love the idea of passive income. The dream is simple and incredibly appealing. You build something once, maybe buy a few investments, and from that moment forward the money keeps showing up automatically. No alarm clock, no boss, no endless emails, just freedom. The internet has turned this idea into a fantasy where someone sets up a few assets and then spends the rest of their life relaxing on a beach while their bank account quietly fills itself. But the truth behind passive income is far more complicated and, honestly, far more interesting. Because the reality is this: living without a paycheck is not about doing nothing. It is about building a system that can support your life even when you are not actively working every day. And those systems are rarely simple. They involve strategy, patience, and a deep understanding of risk. A lot of people believe passive income is like flipping a switch. First you work hard, then one day you stop working forever. But in the real world, financial independence usually looks very different. It is not a clean break from work. Instead, it becomes a mix of investments, occasional projects, careful spending, and constant decision-making. And if that sounds less glamorous than the fantasy, it is also much more powerful. Because when you understand how the system actually works, you can design it in a way that is far more stable than the money while you sleep dream that social media loves to sell. In this breakdown, we are going to pull that system apart piece by piece. We will look at the math behind financial independence, the risks that almost nobody talks about, and the hidden psychological challenges that appear once money stops being your daily problem. Because building passive income the wrong way is not just a financial mistake. If you rely on the wrong assumptions, you might think you are free when you are actually standing on very fragile ground. So before we start talking about numbers and strategies, we need to answer a simple question. What does it actually mean to live off passive income? If you think the answer is just money coming in without work, you are only seeing a very small part of the picture. To understand passive income properly, we need to simplify the concept. At its core, living off passive income simply means that the assets you own generate enough money to pay for your lifestyle. Instead of trading hours for dollars, your money begins doing the heavy lifting. There are generally two main ways this happens. The first method is what many people imagine when they hear the phrase passive income. This is the cash flow approach. In this model, the assets themselves produce income regularly. Rental properties send you rent every month. Dividend stocks pay you quarterly. Bonds generate interest. The money arrives without you needing to sell anything. The second method is a little less intuitive but extremely common among financially independent investors. This is known as the total return strategy. Instead of living only on the income produced by your investments, you gradually sell small portions of your portfolio over time while the remaining investments continue growing. Many people debate which strategy is superior. Some swear by dividends and rental income because it feels more stable. Others prefer the flexibility of selling investments when needed. In reality, the most resilient financial plans often combine both methods rather than relying on only one. But before deciding which path sounds better, we need to talk about the number that quietly sits at the center of almost every financial independence conversation. If you have spent any time researching early retirement, you have probably heard people mention something called the 4% rule. This simple rule has become one of the most widely used guidelines for estimating how much money someone needs to live without a paycheck. And while the rule sounds incredibly straightforward, once you look closely at the math behind it, things become much more complicated than they first appear. The 4% rule became popular because it offers a quick way to estimate how much money someone might need before they can stop relying on a traditional job. The basic idea is simple. If your investments are diversified across assets like stocks and bonds, you may be able to withdraw around 4% of your portfolio in the first year of retirement and then adjust that amount for inflation each year afterward. For example, imagine someone has saved $1 million. According to this guideline, withdrawing 4% would give them about $40,000 to live on during the first year. If inflation increases the cost of living, they slightly increase the withdrawal in later years to keep their lifestyle stable. Because of this rule, a shortcut calculation became extremely popular among people chasing financial independence. Instead of focusing only on income, they calculate the size of the portfolio required to support their expenses. The logic is straightforward. If 4% of your investments pays for your life, then the portfolio needs to be about 25 times your annual spending. So if someone spends $40,000 per year, they aim for roughly $1 million invested. If their lifestyle costs $80,000 per year, they aim for $2 million. It sounds neat, predictable, and mathematically clean. But the problem is that this rule was never meant to be a promise. It was based on historical market data, and markets rarely behave in smooth, predictable ways. Some economic environments are far less forgiving than others. In fact, more recent research suggests that during periods when stock valuations are high or bond yields are low, withdrawing 4% every year might actually be too aggressive. In those cases, a safer withdrawal rate could be closer to 3.5%. And that tiny difference changes the entire equation more than most people realize. At first glance, the difference between withdrawing 4% and 3.5% sounds tiny. But when you translate that into real numbers, the gap becomes much larger than most people expect. Imagine your lifestyle costs around $40,000 per year. Under the traditional 4% rule, you would aim for a portfolio of about $1 million. That sounds like a huge goal already, but it is still within reach for many disciplined savers. Now adjust that assumption slightly. Instead of withdrawing 4% safely, imagine the sustainable rate is closer to 3.5%. Suddenly, the required portfolio is no longer $1 million. You now need closer to $1,150,000 to generate the exact same $40,000 of yearly income. That extra $150,000 is not a small adjustment. For many people, it could represent several additional years of work and saving. And this highlights an important truth about financial independence. Small changes in the assumptions can dramatically change the outcome. A slightly lower return, a slightly higher withdrawal, or a few unexpected expenses can shift the entire timeline. There is also another detail many people misunderstand about this model. When you follow a withdrawal strategy, you are not technically living off pure passive income in the traditional sense. You are not only collecting dividends or interest. Instead, you are slowly selling portions of your investments over time. The expectation is that the remaining investments continue growing faster than the rate at which you withdraw money. If that balance holds, the portfolio can last for decades. But there is one silent force that constantly works against this plan, and it rarely gets enough attention. That force is inflation. Inflation is one of the most underestimated forces in personal finance. It works quietly in the background, slowly increasing the cost of almost everything in your life. Groceries become more expensive, utility bills creep upward, and everyday services gradually cost more than they used to. At first, the changes feel small, almost invisible. But over long periods of time, the effect becomes dramatic. Imagine someone builds a portfolio that allows them to withdraw $40,000 per year. At the moment they retire, that income might comfortably cover rent, food, transportation, and entertainment. Everything seems perfectly balanced. But if inflation averages around 3% per year, the purchasing power of that $40,000 slowly erodes. After 20 years, maintaining the exact same lifestyle could require closer to $70,000 annually. Nothing about the lifestyle changed. The only difference is that prices kept rising. This creates a serious challenge for any passive income plan that relies on fixed payments. If your income comes from assets that never adjust for inflation, such as certain bonds or fixed annuities, your lifestyle effectively becomes smaller every single year. This is one reason many investors prefer portfolios that include stocks. Historically, companies have been able to raise prices along with inflation, which allows their profits and stock values to grow over time. In theory, this helps protect long-term purchasing power. But even with investments that grow, there is still another trap waiting for people who want their income to arrive automatically every month. And that trap appears most often in the world of cash flow investments. When people imagine passive income, they usually picture one thing above all else: steady cash flowing into their bank account every month. Rent checks, dividend payments, royalties, or interest payments. The dream is simple. You keep the original asset forever and live only on the money it produces. On the surface, this feels much safer than selling investments. If you own an apartment building, the building still exists. If you own shares in a company that pays dividends, you still hold the shares. The idea is that the golden goose stays untouched while you live off the eggs. This concept is incredibly attractive, which is why so many people rush toward cash flow investments without fully understanding the numbers behind them. One of the biggest misunderstandings happens with real estate. Someone might buy a property that rents for $2,000 per month and immediately assume they now have $2,000 of passive income. On paper, that sounds fantastic. But that number is only the gross revenue, not the actual profit. From that rent, you still need to subtract property taxes, insurance, maintenance costs, occasional repairs, vacancy periods when the property sits empty, and sometimes property management fees. Large expenses also appear over time, like replacing a roof or upgrading major systems. Once all those costs are removed, the real income can be dramatically lower than expected. And this is the moment when many investors realize something surprising. Instead of owning a passive investment, they may have simply created a new job for themselves. This is where the idea of passive income starts to blur. Many assets that look passive on paper actually require ongoing attention in the real world. Rental properties are a perfect example. Tenants move out, appliances break, plumbing fails, and sometimes you get phone calls at the worst possible times. If you are the one solving those problems, answering those calls, and coordinating repairs, you are not completely passive. You are simply running a small business. Of course, there are ways to reduce the workload. Property management companies can handle tenants and maintenance, but that convenience comes at a cost. Their fees reduce your profit, which means you need more properties to reach the same income goal. This pattern appears in many so-called passive investments. The more hands-off you want the system to be, the lower your returns often become. True passivity usually requires paying someone else to do the work. Because of this trade-off, many experienced investors avoid relying on a single income source. Instead, they build a combination of growth assets and cash flow assets. For example, someone might hold a large portfolio of broad stock market funds for long-term growth, while also owning a few income-producing assets like rental properties or dividend stocks. The growth investments help protect against inflation and expand the portfolio over time, while the cash flow assets provide a steady stream of money for everyday expenses. This hybrid approach adds stability. If one source of income becomes unstable, the other parts of the system can continue supporting the lifestyle. But surprisingly, the most powerful variable in the entire financial independence equation is not investment returns at all. It is spending. Surprisingly, the most powerful variable in the entire financial independence equation is not the return on your investments. It is the amount of money you spend every year. Most people focus all their attention on growing their portfolio. They search for better stocks, better real estate deals, or higher yielding assets. But they often ignore a simple mathematical reality. Every extra dollar you spend increases the size of the portfolio you must build. Think of it this way. If your financial plan follows something close to the 4% withdrawal guideline, every single dollar of yearly spending requires roughly $25 invested to support it. So if someone increases their annual lifestyle by just $1,000, they are not adding $1,000 to their goal. They are adding about $25,000 to the portfolio they need. This becomes even clearer when you apply it to everyday expenses. A small subscription that costs $15 per month may feel insignificant, but over a full year, that becomes $180 of spending. To support that permanently through investments, you would need roughly $4,500 invested. The same logic applies to larger expenses. A $500 monthly car payment adds $6,000 to yearly spending. Supporting that long-term might require around $150,000 invested. This does not mean people should eliminate every comfort from their lives. The real lesson is simply awareness. Every lifestyle choice quietly reshapes the size of the financial system required to sustain it. And once people understand this relationship, they often realize that reducing certain expenses can accelerate financial independence far faster than chasing slightly higher investment returns. But even if someone builds the perfect portfolio and controls their spending carefully, there is still one major risk that can disrupt the entire plan. Even if someone builds a large portfolio, manages their spending carefully, and chooses strong long-term investments, there is still a hidden risk that can disrupt the entire financial independence plan. This risk is known as sequence of returns risk. Most people assume that if the average return of the stock market is strong over the long term, their retirement plan will work smoothly. But the order in which those returns happen can matter far more than the average itself. Imagine two investors who both retire with the same $1 million portfolio and both withdraw $40,000 each year. On paper, their plans look identical. Over the next 20 years, the market delivers roughly the same average return for both of them. But the difference appears in the early years. If the first investor experiences strong market growth during the beginning of retirement, their portfolio has time to grow before large withdrawals reduce its size. Even when markets fluctuate later, the portfolio already has a cushion. The second investor might face the opposite situation. Imagine the market drops sharply in the first few years after retirement. At the same time, they still need to withdraw money to cover their living expenses. This combination forces them to sell investments while prices are low. Once those assets are sold, they are gone permanently. Even if the market recovers later, the portfolio may never fully rebuild because a large portion was removed during the worst possible time. This is why two people with the exact same savings and spending habits can end up with completely different outcomes. And to protect against this risk, experienced investors often add one simple layer of protection to their strategy. The most common solution to sequence of returns risk is simple, yet often overlooked: a cash buffer. By keeping 1 to 3 years of living expenses in cash or short-term bonds, you create a financial shock absorber. If the market crashes early in retirement, you don't have to sell investments at a loss to cover your bills. Instead, you live off the cash while your portfolio recovers. This small adjustment can be the difference between maintaining your freedom and running out of money. But money alone isn't the full story. There's another challenge that many people underestimate: the psychological impact of retirement. Human beings aren't designed for endless leisure. Many people discover that once they quit their jobs, the structure, purpose, and social interaction they relied on vanish. A week at the beach feels perfect, but a year without challenges can lead to boredom, anxiety, or even depression. True freedom isn't just financial. It's also about having meaningful ways to spend your time. This is why the smartest people rarely stop working entirely. Instead, they pursue optional work, passion projects, consulting, volunteering, or hobbies that create value and engagement. The goal of passive income is not to do nothing. It's to gain autonomy over your time. By covering essential expenses with passive income, you can choose work that excites you, without needing it to survive. Finally, there's the distinction between lean FI and fat FI. Lean FI covers only essentials, bare survival, while fat FI allows a luxurious lifestyle with a safety margin. Most successful early retirees aim for a mix: secure basic expenses with passive income and keep optional work for additional income, personal fulfillment, and mental sharpness. The ultimate lesson is this: living off passive income is possible, but it requires strategy, flexibility, and self-awareness. Build the foundation, layer in semi-passive income, maintain a cash buffer, and design a life you want to live. Autonomy, not the size of your bank account, defines true financial freedom.